And so today when we talk about business intelligence, we're talking about the migration from data to intelligence. And inherent to that then are terms like data, information, and business intelligence. And we want to understand what the difference between each of these elements is. So data often tells us what's happening at a point in time, such as sales today. And in other circles, data is thought of as simply discrete observations. They're just simply data points. They tell us nothing other than that on a particular day the temperature was X degrees, or on a particular day our sales were X dollars. Information often tells us what products customers purchased over a period of time, such as last year. And so when we think of information, again, we're thinking of that as data that has been contextualized for us. So the income statement is information. It's all of the balances, which would be the data points of the general ledger accounts, which are data points, summarized into a financial statement that provides or then gives that data context. So information is really data that has been contextualized. In some circles, we can take that a little bit further to say that knowledge is really information that has had judgment applied to it. And so in knowledge management circles, we talk about the difference between data, information, and knowledge. And then in academic circles, we can take that one step further and talk about, well, what's the difference then between knowledge and wisdom? But that's not what we're here to talk about today, so I'll skip that. Business intelligence then uses data mining and predictive analytics to predict what? To predict something, right? So whatever it looks at analytics through data mining to identify relationships between financial and non-financial data. These relationships may not be things that would be as intuitive or apparent to us without the use of analytics, and may not have been something we would have had insight into without the use of data, big data in particular. And so it's the mining of that, the recognition of those relationships, and then the application of predictive modeling to the outcome of that to help us to better inform the decisions that the users of that information might need. And so with that, we say that this explains why additional expenditures for IT may be necessary in order to produce business intelligence, right? Intelligence tools are better suited for data analysis to create business intelligence. So we may end up spending more money on these intelligence tools, but hopefully the output of them is something that we'd be able to leverage to better inform our decision making, because we're always looking at this cost-benefit trade-off. The investment in an accounting system and the relational database may be adequate to store accounting data. However, if a firm wants to do more advanced data analytics to create business intelligence and thus improve decision making, additional investment in intelligence tools may be required. And so we've seen this diagram before. We said there are three aspects to the accounting system: the relational database to store the data, right? The business intelligence analytics to analyze the accounting data, and often a cube is used to represent data analytics because the data can be viewed in various ways, similar to how you can rotate a Rubik's Cube. And because the data stored and being analyzed has value and can sometimes be one of the most important assets that a company owns, it has to be safeguarded using appropriate measures. And so this is why we talk about these three aspects to the accounting system. One is the storage aspect, and that's the relational database. The other is the analytical ability around that accounting data, that being the business intelligence analytics and those tools, and then the safeguarding of all of this. And so this provides us with a model for making decisions. And so when attempting to design an accounting system that will generate data useful for decision making, it is easier to start with a decision making model so that we know what type of information will often be requested. This is an integrated decision model for decision making in today's business environment. And it's just one model of many, but it's a way of helping us to wrap our hands around what's important in order to make a decision around an accounting system. One reason it's called an integrated model is because the model considers both qualitative and quantitative factors. And so both factors are integrated into the final decision. After the decision is made, in Section 5, then we will have to implement the decision, and that's in Cloud 6 there on the screen. And then Cloud 7 is finally the performance resulting from the decision is evaluated so that the quality of the decision can be evaluated as well. The purpose of this step is to improve decisions in the future. And so again, this is just a model or a way of thinking around, thinking about how we would make a decision around a certain something that has different options. So we have an opportunity, we have option A, B, or C. We develop the quantitative and qualitative analysis around A, B, and C. We make our decision, we implement, and then we evaluate. And so if we were to put this decision-making model into a template, we would see here an example of the IBM spreadsheet template. If the decision-making process can be standardized, then it becomes easier to know what information the system will be expected to generate. So this is an illustration of the IBM for espresso coffee. The company was trying to better understand the decision that its customers would make when they are deciding whether to purchase espresso from their local coffee shop or buy one of Espresso Coffee's machines and espresso beans. And so we can see the issue, number one, is to define as whether to purchase an espresso machine and espresso beans. We identify the options is to purchase espresso from the local coffee shop or purchase the machine, option B. We then assign the quantitative aspects or the financial analysis. We decide and assign the qualitative or non-financial analysis, and then we make our recommendation and decisions. So it's just a model, just a way of thinking about a problem to help us wrap our hands around it in its entirety and to help us to think about all of the important elements to it, both quantitative and qualitative. So there are two basic approaches to data analytics for business intelligence. One is shadow data, and this is data that is often stored in spreadsheets throughout the organization that essentially, and we call it shadow data because it shadows the formal accounting system. Then secondly is business intelligence solutions such as those from SAP and Oracle. These technologies often use data warehouses and are generally under the control of the IT department. So when we're looking at how we execute to derive business intelligence, we can do it in one of two ways. Generally speaking, we can either do it through the use of shadow data, which essentially means downloading data out of our database onto desktops or in a user computer environment where then the user can manipulate that data. And there are advantages and disadvantages to this as covered in the text. Or we can rely on business intelligence technologies, which really remove that necessity to maintain this duplicate data outside the system, and it applies these processes to the data in the data warehouse. But because these business intelligence tools, there are integration issues, compatibility issues, other technical issues that come up because they're being applied within the data warehouse environment, it often requires a great deal of interaction with IT, and so they generally remain within the context and control of the IT department. And so here we say we're at the crossroads and we have a control issue. So with respect to business intelligence, the preference for using it may come down to a control issue because, as we said, accounting professionals tend to control shadow data because it's really data pulled from the system and then exercised at the user level versus BI or business intelligence technologies that are generally held by IT professionals. And so here we talk about certain enterprise intelligence systems components. So we have data storage, right? So the data that is being mined has to be stored. We then have this idea of data extraction and transfer. So the data has to be extracted out of the database and moved into the business intelligence environment so that processes and procedures and analytics can be applied to it, which is the data analysis. That's the tools to analyze the data to identify these interrelationships and insights. And then we have this idea of visualization, which we think of in terms of reports, whether they're paper reports or graphs or pie charts or dashboards, or what are the tools and the visualization of the results of the analysis applied to the data. So we have data storage, data extraction and transfer, data analysis, and data visualization with respect to generating business intelligence. And so here we have the 4 intelligence system components diagrammed. Data storage, right? Data transfer and extraction, the data analysis in our cube, and then the data visualization for the users. And so with respect to data analysis and shadow data, if an enterprise is using shadow data to create business intelligence, then the system might be diagrammed as this. Notice that the green shows areas that are secured under IT control, the green circle, where the red circled area shows areas that are under the control of the user, and in this case it's the accountant, right? And we just need to keep in mind also that once we move into this red circle, we generally lose some, have more complicated and complex issues around security, because then this data is essentially outside the database environment, and it's perhaps on a user computer or desktop or laptop, subject to theft, subject to cyber attack more easily than something that would be behind a much more sophisticated firewall, such as the operational database. And so one of the problems that we have with shadow data is that it's on users' desktops, and so you may have multiple different files with the exact same information on multiple different users' desktops that have undergone very similar or different processes to get it into some form or format, and that becomes a problem, because then you have no control over all of those different spreadsheets and applications. So it has come up that perhaps we as users need to be more diligent and execute a global spreadsheet management protocol, which essentially provides controls and identifications on some global basis and some consistent basis across users to help identify that. So this global spreadsheet management program can be used to improve security over shadow data within an organization. All spreadsheets throughout the organization are inventoried, and then each spreadsheet is assigned a unique ID known as an SSID, or spreadsheet identifier. After each spreadsheet has been assigned a unique ID, it is then possible to identify cells in each spreadsheet by preceding the cell and sheet name within the global SSID number. This is a great idea. Practically speaking, it's not executable. We may have multiple, 10, 20, 50, 200, 300 users across an organization, each with 10, 20, 50, 300 spreadsheets under their control at any point in time being worked on to provide information, and to try to execute a spreadsheet identification protocol across all of that really becomes very difficult. And so again, we kind of boil down to, well, what's the cost-benefit trade-off of this, and is it something that's doable? So, but having this actually permits the use of global spreadsheet queries to extract data from multiple spreadsheets. It just, again, it becomes this issue about, do we have the resources to devote toward tracking all of these spreadsheets and then integrating them all using this spreadsheet management option. And again, like I say, I don't see this in practice much at all. I think it's a great idea. It's very difficult to execute for multiple external users of shadow data. And this is just an example of a shadow data dashboard. So using Excel, we can develop these pie graphs or pie charts and bar graphs, and provide users with a lot of information that's visually very appealing, similar to what business intelligence would provide them. It's just a different way of getting to it. And so another option other than shadow data is through this idea of business intelligence technologies. And that's what this diagram does. It shows the components for BI technologies. Notice that since the components are under IT control, the security is often considered higher than for shadow data. This is indicated by the green circle around all 4 components. if you recall earlier, the green circle was around the bottom two components, the cube and the accountant, and the red circle was around the, the red circle was around the accountant and the cube. The green circle was around the section ODDC above to data warehouse. And in BI technologies, all of this processing, the transfer, the analytics, and the visualization is considered to be under the control of the IT department. And so BI technologies typically use data warehouses. The data warehouse structure differs from the relational database structure used for accounting databases. In a relational database, the query might combine multiple tables to extract data needed. So the query might have to use 20, 40, or 60 relational database tables. This slows down the querying process. The data warehouse structure uses a dimensional database. Notice in the data warehouse structure that there is a table in the middle, and the query combines only two tables to extract required data. So the extract, load, transform, or ELT phase involves extracting data from the operational database. Then the data must be transformed into a data warehouse dimensional table, and the data is then loaded into the data warehouse dimensional table. This shows an example of a BI digital dashboard, and it's similar to what we looked at earlier with a shadow data dashboard, but it has a little more visual appeal to it. And again, these business intelligence technologies usually cost some money, so we expect to get a more quality output or product from it. And these digital dashboards are created using BI technologies, maybe more sophisticated than those using the spreadsheet software, simply because of the functionality in the dashboard or in the BI technology dashboard area. But again, it's showing us what we consider to be key metrics, key areas of measurement interest that some level of management wants to see on some routine basis. And so they can skip through all the detail and look very quickly at these dashboards and determine, again, on budget, above budget, below budget, something we need to be concerned about, something we don't need to be concerned about. It provides us a very quick and easy view of this, so we can move from the areas that we see we need to not be concerned about or focus much on into the areas that we really need to pay attention to. And so security for business intelligence technology, as indicated by the green circle, is often superior than security for shadow data. And I think that makes perfect sense when we think about this as users and the level of security around what surrounds your corporate IT headquarters, organization level database, and the security that's on your particular laptop or desktop, right? Shadow data may be exported to a spreadsheet on a laptop that is carried throughout airports, left in coffee shops. There's all kinds of risk for exposure once it gets onto a laptop or even a cell phone, right, or mobile device. So we can see that the security is generally much more lax there. And all this is doing is comparing the different intelligence tools, the business intelligence technology, and the elements or characteristics of it, and then this idea of shadow data. And so take, for instance, this business intelligence technology, possibly Sarbanes-Oxley SOX compliant, versus typically not SOX compliant. And so when a manufacturer is developing a business intelligence technologies to appeal to its particular client base, it may have to consider Sarbanes-Oxley reporting requirements and build that into its products, versus an end user who's downloading information to use in an Excel spreadsheet that may have to make sure that when that information is reported, it's SOX compliant. But there's a phase between the download, development, and analytics and the reporting where that would come in. It wouldn't be considered compliant from the point of download, which is the difference between that and business intelligence. And so we can see some of the different characteristics as they are compared and contrasted in this table. And so this finishes up our discussion of Chapter 7. This is an important item, and we'll have other learning exercises and practical applications of this, because it is such a growing hot topic in the accounting environment and in the information technology environment today. And so I encourage you to read this chapter, and there'll be other readings that are made available. I encourage you to go through there and give this some thought, because if you're at all interested in this area, it is an exciting, dynamic, and changing area. And so I encourage you to explore it further as your interests dictate. So I appreciate your time, and I look forward to talking to you with respect to Chapter 8 and sustainability, intelligence, and reporting.